Welcome back to the channel. Today, we're diving into one of the most powerful yet often misunderstood strategies in Australian tax planning: salary sacrifice. Maybe you've heard colleagues talk about salary packaging. Maybe your employer has mentioned it, but you're unsure how it actually saves you tax. Or maybe you're worried about whether salary sacrifice could backfire and leave you worse off. In this video, I'll explain what salary sacrifice is, how it works in Australia for the financial year 2025 to 2026, the potential tax benefits, the traps to avoid, and the real financial consequences if you don't set it up properly. And you'll know how to use it wisely to boost your savings, superannuation, or lifestyle benefits without triggering unexpected tax bills. So let's start with the basics. Salary sacrifice, sometimes called salary packaging, is an arrangement where you agree with your employer to give up part of your future salary in exchange for benefits of equal value. Instead of being paid all of your salary in cash, your employer uses part of it to provide benefits like extra contributions to your superannuation fund, a car through a novated lease, work-related devices like a laptop or phone. In some cases, things like childcare or certain living expenses, depending on your employer. The key idea is this: by taking part of your pay as benefits, you may reduce the amount of taxable income shown on your payslip. That can lower your income tax and sometimes reduce other costs like Medicare levy surcharge or HECS and HELP repayments. But here's the catch: not all benefits are treated equally. Some are tax effective, while others might trigger fringe benefits tax or limit your cash flow in ways you didn't expect. So why do Australians use salary sacrifice? The main motivations are: 1. Tax savings. You may pay less income tax if your taxable salary is reduced. 2. Boosting retirement savings. Sacrificing salary into super can take advantage of concessional tax rates inside superannuation. 3. Accessing perks, like a car or laptop, without paying full cost from after-tax dollars. For most people, the biggest benefit comes from salary sacrificing into super. Let's break that down in more detail. When you salary sacrifice into super, your employer contributes extra amounts to your super fund on top of the compulsory super guarantee. Super contributions from salary sacrifice are generally taxed at 15% inside your super fund instead of your marginal income tax rate. Let's look at an example. Imagine you earn $90,000 a year. On that income, your marginal tax rate for 2025 to 2026 is 32.5% plus Medicare levy. If you sacrifice $10,000 of your salary into super, you don't pay 32.5% tax on that money. Instead, your super fund pays 15%. That's a tax saving of 17.5%, or $1,750, on that $10,000 contribution. Now, of course, you can't access that money until you retire, but the tax benefit is significant. Over a working lifetime, salary sacrificing into super can add hundreds of thousands of dollars to your retirement balance. But, and this is important, you need to be mindful of contribution caps. For 2025 to 26, the concessional contributions cap is $30,000 per year. This includes your employer's compulsory 12% super guarantee plus any salary sacrifice amounts. If you go over the cap, you may be hit with additional tax and penalties. So always check how much your employer is already contributing before deciding how much to salary sacrifice. Super is the most common, but let's talk briefly about other salary sacrifice benefits. 1. Novated leases for cars. This is where you salary sacrifice a portion of your pay to cover the lease payments, running costs, and maintenance of a car. It can be tax effective because some of these expenses are paid pre-tax. But remember, novated leases are subject to fringe benefits tax. This means the tax office still gets its cut, but depending on the structure, it can still be cheaper than paying for a car with after-tax dollars. 2. Work-related devices. If you need a laptop, tablet, or phone for work, some employers allow you to salary sacrifice these items. If the device is primarily for work use, it can be provided without attracting FBT, making it a tax-free perk. 3. Other benefits. Certain employers, especially in not-for-profit sectors like hospitals or charities, may allow employees to salary sacrifice living expenses such as rent, mortgage payments, or entertainment. These are often capped and heavily regulated, but they can provide significant tax savings in those industries. Now let's look at the tax consequences. starting with the positives. 1. Lower taxable income. By reducing your taxable salary, you may drop into a lower marginal tax bracket or avoid thresholds like the Medicare levy surcharge. 2. Superannuation growth. Contributions into super are taxed at only 15% for most people, allowing your retirement savings to grow faster compared to keeping that money as take-home pay. 3. Access to pre-tax benefits. Some benefits like work-related devices or not-for-profit salary packaging can be completely tax-free. But, and this is where people get caught, there are also downsides. 1. Reduced take-home pay. Salary sacrifice reduces the cash in your pocket today. If you overcommit, you might find it hard to meet living expenses. 2. Contribution caps. As I mentioned earlier, exceeding concessional contribution caps for super leads to extra tax and penalties. You'll lose much of the tax benefit. 3. Fringe benefits tax, FBT. Not all benefits are FBT free. If your arrangement attracts FBT, your employer might pass the cost on to you, making the whole strategy less worthwhile. 4. Impact on other entitlements. Salary sacrifice can affect income-tested benefits and obligations. For example, your taxable income might drop, but your reportable super contributions or reportable fringe benefits still get added back when calculating things like childcare subsidy, HECS and HELP repayments, Medicare levy surcharge, family tax benefit eligibility. So you can't always escape obligations by reducing taxable income. 5. Super access rules. Money sacrificed into super is locked away until you reach preservation age or meet a condition of release. If you need that money sooner, you can't access it. Let's go through some common mistakes Australians make with salary sacrifice. Not checking caps. People forget that employer contributions count toward the concessional cap, then accidentally exceed it. Assuming all benefits are tax-free, some benefits trigger FBT and actually leave you worse off. Salary sacrificing too much, leaving yourself short on cash for bills and lifestyle needs. Not getting written agreements. The ATO requires salary sacrifice arrangements to be documented and set up before the income is earned. You can't decide after the fact. Forgetting about reportable amounts, which can still affect HECS or Centrelink, even if taxable income looks lower. Let's bring this to life with an example. Jane earns $100,000 in financial year 2025 to 2026. Her employer contributes $12,000 in super guarantee. Jane decides to salary sacrifice $15,000 into super. Here's what happens. Her taxable salary drops to $85,000. The $15,000 goes into super, taxed at 15%. So $2,250 is deducted, leaving $12,750 added to her retirement savings. If she had taken that $15,000 as salary, she would have paid about 34.5% tax, including Medicare levy, or $5,175 in tax. By sacrificing, she saves almost $3,000 in tax. But her total concessional contributions are now $27,000. That's under the $30,000 cap, so she's fine. If she had sacrificed $20,000 instead, her total would be $32,000, and she'd pay extra tax on the excess. Here is a checklist if you're considering salary sacrifice. 1. Check your employer policy. Not all employers offer salary sacrifice, or they may limit the types of benefits available. 2. Know the tax rules, especially contribution caps and FBT. 3. Calculate your cash flow. Make sure you can afford reduced take-home pay. 4. Get it in writing. Agreements must be in place before income is earned. 5. Review each year because tax rules, caps, and your circumstances change. Is salary sacrifice worth it? For many Australians, especially middle to high income earners, salary sacrificing into super is one of the most effective ways to save on tax and build wealth for retirement. But it only works if you stay within contribution caps. You understand the effect on other entitlements. You can afford less cash today for more savings tomorrow. When it comes to other benefits like novated leases or devices, the value depends on your personal circumstances and whether FBT applies. Salary sacrifice is powerful, but it's not free money. It's a tool. By using it wisely, it can cut your tax bill and grow your wealth. Used poorly, it can create unexpected debts, cash flow problems, or tax headaches. If you're thinking about salary sacrifice in financial year 2025 to 26, take time to run the numbers, check the rules, and seek professional advice if needed. That's it for today's video. If you found this helpful, make sure you subscribe for more Australian tax and money tips. Thanks for watching, and I'll see you in the next video.